Equities posting their strongest positive reaction to retail sales data in 6 months this morning, as the print indicates strength in consumer spending. While the headline sales number came in squarely above estimates, could markets be getting ahead of their skis? Here to discuss, we've got Angelo Kourkafas. He is Edward Jones' senior investment strategist. And Angelo, it's great to speak with you. So we talked briefly about this before our show, but let's put a button on it. Did we do it? Are we at the soft landing? Is it happening?
Yeah, so today we got a nice upside surprise in retail sales and a downside surprise in jobless claims. Exactly what was needed to put some of the recession fears to bed. So thinking about the consumer that's resilient, the US economy that's resilient, plus we have inflation moderating and coming closer to the Fed's target, that is a recipe for a soft landing. Of course, there's a flip side to that coin, that's interest rate expectations. But that's to follow.
I'm interested in what you thought about the retail sales data, because if you take a look at discretionary spending under the hood, we are seeing a little bit of a retracement there and consumers slowing down ever so slightly. Is there any chance that the market is overthinking the headline and ignoring some of the details underneath the hood that could be more indicative of the consumer?
No doubt there was a boost from very strong vehicle sales. We had back in June an incident with a cyber attack on auto dealerships. So this month in July, we did see a strong rally, mean reversion from that. But beyond auto sales, we did see a broad advance in retail sales, with 10 of the 13 categories being higher. So I would say the message is undoubtedly a strong one for the consumer, but bear in mind that retail sales only give us a part of the story. It only shows spending on consumer goods. We still don't have a good sense of spending on services, which that's the area we are seeing a little bit more of a slowdown as consumers spend less on travel than they used to. But overall, I think the consumer remains resilient and is doing what they know to do best, and that's to spend. And that's the biggest driver of the US economy.
So then, Angelo, kind of wrapping that up and going back almost to Maddie's first question there, when we were talking about the risk of a recession, what is your assessment then in terms of where we stand? Because yes, there is, it's almost like you can pick and choose what data points you want to focus on to support whatever argument you are trying to make. And it certainly seems like, at least from the research reports that I've been reading over the last several months, that continues to be the case.
Yes, I think the broader theme, if we take a step back, is that the economy is slowing, but it's still growing. And that's a very important distinction. We're not talking about a contraction, as was the fear after the last jobs report. The economy continues to add jobs. Real earnings are positive after inflation. They have been for the last 14 months. Plus, we have lending conditions that are easing. While at the same time, the Federal Reserve is about to embark on a multi-year rate cutting cycle. So putting everything together, we're in a different economy than we were last year. We are transitioning from a 3 to 4% type of growth world into 1 to 2%. But that doesn't mean that something worse is ahead of us. And still, the pullbacks and volatility that we have seen more recently can be thought as taking place within the confines of an ongoing bull market.
Angelo, I want to talk about how you're positioning around that thesis. Right before we saw that volatile week with the sell-off, the new narrative was one of a market rotation out of big tech and into the other 493. Does today's data support a continuation of that rotation? And is it into 493 or is it into small caps in the Russell 2000?
Yeah, I think so. The broadening of market leadership will remain a prevalent theme in the remaining months of the year. We have a resilient economy, which means that there is still growth. And we know there's a big valuation gap between the 493 and the Magnificent Seven. And when we look at earnings, which is one of the fundamental drivers of stock prices, the gap between the Magnificent Seven and the rest of the market is starting to narrow, especially as we look at Q3 and Q4. And that's part of tough comparisons for the Magnificent Seven. Plus, for the remainder companies, we have still positive economic growth. And after earnings stalling for more than a year now, they are bouncing back with a rebound in margins as some of the price pressures are easing.
So, Angelo, what do you think that tells us then about the likely action we're going to see as we look ahead to, obviously, we typically do see a little bit more volatility leading up to the U.S. election. How should investors, or what should investors then be doing over the next several weeks to better position their portfolios post-election?
Yes, I think having the right expectations about returns and volatility is important because we are, as you mentioned, in a seasonally challenged part of the year, thinking about late August, September, October, especially in an election year, we tend to see volatility, looking at the VIX index, spike. But that spike, that uncertainty that is associated with the election, we have seen historically very quickly subsides. So if we do have an election-driven pullback in equities, given the relatively favorable backdrop, we would use those pullbacks as an opportunity to either diversify, deploy some capital, and be opportunistic while this happens. And going back to the point about small caps, I think mid caps is a compelling part of the market. It is more levered, more exposure, that has more exposure to positive economic surprises and has a valuation advantage over large caps. But at the same time, it is higher quality than some of the small cap stocks.
All right, Angelo Kourkafas, it was great to have you. Thank you so much for joining us here this morning. Edward Jones, Senior Investment Strategist. Thanks, Angelo.
Thank you.